Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. Do you know what a Yugo is? A Yugo is a subcompact hatchback car manufactured in communist Yugoslavia from 1980 to 2008. It was known in the United States for being the cheapest car sold. Initially priced under $4,000, but it quickly became known for its poor quality, reliability issues, and questionable safety. The joke about the Yugo was this: why does a Yugo have a rear window defroster? The answer? So that you can keep your hands warm while you push it. Now, would it ever make sense for a headline to read, "Yugo is proof the auto industry is collapsing"? Does that make sense? Of course not. That's absurd. Just because a Yugo was a lousy car doesn't mean that a Tesla or a Lexus or a Rolls-Royce are bad cars. That would be absurd to make that connection. Well, that's what the New York Times did in this article. They want us to believe that one small insurance company that had less than 1% of the market share is proof that the entire long-term care insurance industry is collapsing. The Wall Street Journal tried to paint the same picture in 2016 with their article, ominously entitled, "Collapse of Long-Term Care Insurer Reflects Deep Industry Woes." In an effort to speak not so kindly of the entire long-term care insurance industry, the New York Times uses as an example probably one of the least financially stable companies to ever sell long-term care insurance. The company was called Penn Treaty. Penn Treaty's failure had many different causes. It had below average financial ratings. It offered policies with richer benefits than the rest of the industry. It had premiums that were much lower than the rest of the industry, and they accepted applicants who were often denied coverage by other insurers because of their health problems. But the biggest problem, and the number one cause for Penn Treaty's financial demise, is that Penn Treaty ignored the federal guidelines for long-term care insurance benefit triggers. The federal government recommended, and the rest of the long-term care insurance industry has used since 1997, activities of daily living to determine when a policy would pay benefits. Penn Treaty used instrumental activities of daily living on their number one selling long-term care insurance policy. Now, instrumental activities of daily living are managing finances, using the phone, preparing meals, housekeeping, shopping, managing medication, and using transportation. So someone could qualify to receive benefits from Penn Treaty's number one selling policy if they only needed help with shopping and cooking, for example. It's no wonder Penn Treaty had to be taken over by the insurance regulators. Insurance companies selling long-term care insurance today have been in business, on average, for over 130 years. That means that most insurance companies selling long-term care insurance today have gone through the Great Depression, 2 world wars, the Panic of 1907, the oil embargo, double-digit inflation in the 70s and 80s, the 2008 mortgage crisis, not to mention the COVID shutdown. The average insurance company selling traditional long-term care insurance today has been selling it for over 27 years. And for the 10 companies selling traditional long-term care insurance today, their AM Best rating for financial strength are either superior or excellent. Contrary to the New York Times article on long-term care insurance, the insurance companies selling long-term care insurance today do not have wobbly finances. Just the opposite is what's true. In the next episode of our in-depth analysis of the New York Times article on long-term care insurance, I'll explain what the Times meant when it said that long-term care insurance is risky.